Welcome back. It's great to have you with us on Primetime Business News. Now, a lot of focus on the Finance Minister, but something else big happening this week. The Reserve Bank announcing its decision on interest rates tomorrow. Rates are largely expected to remain unchanged. South Africa, of course, has slowly been raising interest rates recently to fight inflation. The repo rate, the benchmark rate that the Reserve Bank lends out to banks at is 7%. The prime lending rate that affects most consumers, 10.5%. Indebted consumers will benefit the most if rates start coming down this year, but is it possible? Well, ahead of that decision, let's also look at the property market, which is always heavily influenced by mortgage interest rates. To discuss, we're joined by FNB Property Strategist, John Loos. Great to have you with us.
Hi,
John.
Francis.
So your latest property barometer, you talk about house price realism and some market balance. Just tell me what's going on.
Well, at the moment, we're just seeing early signs of a possible slight pickup in the market again. It's been in the doldrums. It was slowing through last year. Transaction volumes were slowing. House price inflation is almost non-existent. But there are just early signs. The average time on the market in the first quarter shortened a bit, according to our estate agent survey. That's a good sign. And then the leading business cycle indicator of the Reserve Bank and of the OECD, all pointing upwards now. Commodity prices better, drought conditions may play a role in boosting economic growth. So slightly stronger economic growth looks like it could have some positive impact on residential demand.
So it's looking better, I think, than at the start of the year, some downbeat predictions. So this is good news if you own a property or you're planning to sell, things like that.
Yeah, look, I don't think it's going to shoot the lights out, but I think just a mild improvement could make it slightly better from a seller's point of view. And that, I think, will happen, that mild improvement I talk about will happen even if interest rates just stay level for the year. I think the longer interest rates stay where they are, they've been at these levels for a year now, and don't hike any further, I think that alone could be a mild positive, just because people tend to forget about interest rate hiking as it fades further into the past. And they slowly gain a little bit more confidence when it comes to buying homes.
What does a mild improvement mean? Because house prices have to go up further than inflation for you to make a profit. I think, and you can correct me, that during this time, the last year when rates were flat and before that when rates were going up, property prices generally kind of going down.
Yeah, look, I think for the next few years, we could be, for most of the time, we could be in real house price deflation. In other words, I don't think house price inflation is going to match CPI inflation a lot of the time. So that would be real decline. But when I talk about a mild improvement, I'm talking about the moment, or in February, we had a 0.8% year-on-year price growth according to our index. As the year goes on, I expect it to just maybe get up more into the 3 to 4% levels. It's not great, but
you're still losing value, but not as much.
And a little bit of improvement in demand and perhaps transaction volumes just turning positive again after some decline late last year.
All right, your prediction for tomorrow, do you agree with most economists, no change?
I think so. We still see CPI inflation slightly outside the upper target limit, but as time goes by, food price inflation, I believe, should come off, given that drought conditions have been alleviated. So as time goes by later in the year, I think we'll move back into the target range. On the other, so that's the downside risk, and that's the rate cut risk, although we don't, our base case is not for a rate cut this year. On the other side, the ratings downgrades ever loom, the political issues, the issues around Minister Gordon, that can put pressure on the rand, and that's the upside risk. So there's two sort of risks to these forecasts at the moment, and we're right in the middle. We just believe that the Reserve Bank is a reluctant mover at the moment, and should inflation just reasonably behave itself and not go shoot way out of the target range, we think that they'll just try to keep the rate stable.
So if our politics stabilizes and inflation behaves itself, like you say, you don't believe that rates could go down? Because at one point the Reserve Bank governor was hinting that the next move, if all goes well, could be down.
It is possible, but yeah, that would mean rand behavior, good rand behavior, good, a good political situation. But you know, what I guess counts against that a bit is that rates are relatively low as it is. The Reserve Bank, when they were hiking the rates gradually, were saying that they would normalize. All they were doing was trying to normalize rates, really. And I would say that where we are now is a normal bottom of the cycle rate level, given our inflation rates. So I'm not convinced they'll move quickly on the to cut rates. But yes, you know, if inflation drops more than expected, you know, if hypothetically it doesn't go to 5% but down to 3 point something, you know, if there's a bigger dip in food price inflation and other things, yes, I guess then rate cuts could be that is a possibility.
How sensitive is the housing market to, say, a 0.5% up or down? Do we see a big change, or is it also about how people are feeling and a whole lot of other factors? What do you actually see when we do see a change?
We don't see a big change, I don't think, but you know, every little bit helps. I think just even if rates just do go sideways this year, that memory of rate hiking fading further into the past, that alone will have some positive impact on the market. A rate cut, should it occur at some stage this year, would have a further impact on demand. But you know, it's really not going to make massive differences. I think by and large we're you know, for the next few years we're in single-digit price inflation territory. Apart from the Western Cape in recent times has been in double-digit territory. That's got issues of its own, positive issues of its own, but nationally, you know, we're a low-growth economy. No real signs. Even better economic growth this year. We're talking about 1 point something. You know, it's not nothing is exciting at the moment in the economy. So shouldn't expect too much in the housing market.
So finally, I guess just your advice. So we've got low interest rates at 10.5 prime. Maybe you can put that in context historically. Does that mean you should think of getting in if you can? What does it mean in general?
Well, I think it means that for a buyer, I don't think there's any rush. You know, the one thing about boom times is they cause buyer panic. These first time buyers who panic that if they don't get in quickly with the sort of massive price growth that you see at times, they won't be able to afford it ever again in the future. I think that's off the table for, you know, for a good number of years to come. The household sector is highly indebted. The economy is sluggish. So, you know, I think one can take your time as a buyer. You can shop around. You can put in a good, you know, a low offer and see what happens. I don't think there's going to be any pandemonium in this market and frantic rush to buy houses on a large scale.
Except in Cape Town, which I'd love to chat to you sometime.
Except in Cape Town, around that mountain.
We'll have to leave it for next time, because it is fascinating, this vast anomaly in the Cape. But that was FNB's John Loos agreeing with most economists. No change tomorrow in interest rates and the rest of the year. Well, it depends on a whole lot of things. We'll bring you that decision live tomorrow.